Jeremy is saying, what are some financial metrics that venture capital firms use to gauge pre-revenue startups? Yeah, it's tough. It's tough. So when it comes to venture capital investors, the most important thing is they look at the quality of the management team, because ideas are commodities, but execution is not. And so it's kind of a qualitative metric, but they look at how many companies has this CEO started before in the past. And is she or he had exits and been successful? And what is the work experience like of the rest of the management team? So that's what I would say. And they also look at the quality of the investment syndicate if there's other investors. Now, in terms of quantitative metrics, it's a lot less sophisticated than you think. Like I was a little bit disillusioned and disappointed in the whole process, because when I worked in the hedge fund industry and when I worked at Goldman Sachs and all that stuff, I found that we did a heck of a lot of detail work on creating financial models, meaning predicting what a company's going to be worth in the future. But when it came to venture capital, there really wasn't that much of that. Now, a lot of times people will forecast based on the TAM. The TAM stands for total addressable market. And so venture capital firms usually don't like investing in companies that aren't in a massive total addressable market of $20 billion. And the reason I say $20 billion is because in the unlikely event that a startup hits it out of the park and gets 5% share, 5% share, which is massive. 5% share of a $20 billion market is $1 billion in annual revenues. So they look at the size of the TAM, or the potential TAM in the future. And when it comes to quantifying what to value the company at when they invest, venture capital firms, they do create financial models. And they'll forecast mainly the income statement. And because the companies aren't profitable, and many of them aren't profitable even until 1 or 2 years after IPO, what happens is a lot of venture capital firms look at revenue multiples. So they'll look at price to revenue, and they'll look at price to revenue compared to similar companies in that sector. So for example, in the summer of 2012, I invested in 3 great IPOs. One was Splunk, ticker SPLK. The other one was Workday, ticker WDAY. And the other one was ServiceNow, ticker NOW. And those 3 subscription-based enterprise software companies traded between 15 and 20 times revenue during the IPO. And so that's how I set the valuation I thought other similar companies with great management teams and great growth profiles as well should trade at. And then eventually those companies became profitable, post IPO. And so once they were profitable, then you value the company based on earnings. But I think that for a lot of private companies, there is no earnings. And so the best way to value initially is to look at a price to revenue multiple.